Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi. It is 8th of November 2023 and here are the questions we will be answering today. Is Adani looking to exit the FMCG business? Why is Surat diamond industry losing its shine? Will the recent optimism in equity markets last? And how did Angelo Mathews get timed out? The Adani Group is reportedly exiting from its joint venture with Singapore's Wilmar Group, and with it, the conglomerate is also bidding adieu to India's FMCG sector, which was once its core area of business. But why is Adani exiting the FMCG business, and what would be its likely impact on the group? Abhijit Kumar finds out. Almost 24 years ago, Adani Wilmar Limited began as an equal joint venture between Adani Enterprises and Singapore-based Wilmar International. Over the years, it has become known for its popular brands such as Fortune Cooking Oil and other edible products. Adani Wilmar penetrated the highly competitive FMCG market through its Fortune brand. It acquired a host of refineries and seed processing units and developed its export network in Ukraine, Ghana, etc. through capacity expansion. Presently, the company holds a significant position in the FMCG sector, offering a wide range of products in its portfolio. Speculations of Adani Group seeking to sell its entire stake in Adani Wilmar has been doing the rounds for a while now, but the company had denied the reports through an exchange filing earlier this year. But is there a business case for the Adani Group to exit FMCG entirely? Sriram Subramaniam of InGovern Research Services believes that the company may be looking at moving away from its non-core businesses and consolidating its core infrastructure segments.
They are obviously getting that $2-3 billion, whatever is the discussion. So because they own 43% of the listed entity and today's market cap is about 45,000 crores. That itself is a huge cash inflow. Two is, obviously, their focus will be much sharper on infrastructure sector. Today, FMCG is a very competitive market. Even Reliance is investing very heavily. ITC, HUL, and all are sharpening their focus. So, from that perspective, Adani's in infrastructure are sort of used to monopoly or oligopolistic kind of market structures.
In its quarter report for Q2 FY24, Adani Wilmar reported a loss of nearly 131 crore rupees, an increase of 65.6% compared to Q1 FY24, where the company reported losses worth 78.9 crore rupees. The company had reported a profit of 39 crore rupees in the second quarter of FY23. Analysts believe that by exiting the FMCG sector, the Adani Group can channel its resources and expertise into its core sectors, potentially leading to stronger growth and market dominance. It may as well reduce exposure to the volatile FMCG market.
It should be positive for all the shareholders. Adani gets the funds needed for its other businesses. I assume their stake would be bought by Wilmar, which will ensure a more focused approach, as Fortune brand is one of the most visible brands in that space. This will also ensure better wealth creation for the public and the institutional shareholders. However, Wilmar, being an existing promoter, could get an exemption from making an open offer unless they would like to delist the company. Anyways, the public holding is just about 12%.
Exiting FMCG also means reduced diversification in Adani's portfolio, which can potentially expose the group to higher risks in its core sectors. The Adani Group's potential exit from the FMCG business signals the conglomerate's strategic portfolio reevaluation. In response to increased scrutiny, the company has taken proactive steps to regain market and investor confidence. However, experts caution that while the move promises streamlined growth and resource allocation, it is not without its risks and challenges. Did you know that Gautam Adani started off as a diamond sorter in Mumbai, and he became a millionaire by 20 thanks to his diamond brokerage business. But the diamond business, which gave Adani an early leg up, is not in a good shape. Thousands of workers in Surat, which is the hub of diamond cutting and shaping industry, have left the city. Once thriving with diamond workers, artisans in the city are now struggling to make ends meet. Kasturi Akhil finds out why are Surat's diamonds losing their shine.
First, the working hours were reduced. Then, the days of employment were cut short. Then came the news of job losses. And then, sporadic reports of suicides by contractual workers. Bylanes of Surat were never so gloomy. Reeling under the shock of the pandemic, Surat's diamond cutting and polishing industry was trying hard to recover when the Russian attack on Ukraine and subsequent global slowdown dealt a big blow to it. And then came the war in Israel. The country is a significant center in global diamond trade and is also a major export destination for raw diamonds from India. Vipul Shah, chairman of Gem and Jewelry Export Promotion Council, told media that India's exports of gems and jewelry to Israel amounted to about $1,300 million during the fiscal year 2022-2023. India's diamond business has seen a steady decline ever since the Russia-Ukraine war escalated. Imposition of sanctions on diamonds mined, produced or processed in Russia took a big toll on Surat's diamond industry. According to reports, Russian rough diamonds account for over 30% of the total rough imports in India.
With the global uncertainties, especially which started with the Russia-Ukraine war and now the Israel crisis, the demand for the finished product, which is the jewelry which uses these cut and polished diamonds, is coming down. Therefore, US buying has reduced to a great extent. This has pushed the diamond cutting and polishing units into some sort of a downturn, and they are not able to provide enough work to their artisans who cut and polish these diamonds. Some of these smaller units, almost 500 of them, have asked their workers to go on an early Diwali break this year, which has already started, and most of them have not been given a fixed date of return. These workers do not usually get paid a monthly salary. They are paid according to the amount of work or the quantum of carats that they are cutting and polishing.
According to data from the Gems and Jewelry Exports Promotion Council, gross exports of cut and polished diamonds have declined by about 29% between April and September 2023. Meanwhile, imports of rough diamonds also witnessed a 21% decline year-on-year during the same period. Recently, the Gem and Jewelry Export Promotion Council called for a temporary ban on imports of any rough diamonds from 15th of October till 15th of December. The aim is to clear the existing inventory of rough diamonds amid slowing global demand. But there is a silver lining. While demand for cut and polished natural diamonds from large consuming economies such as the United States and China has taken a hit, the demand for lab-grown diamonds is relatively stable. Experts say lab-grown diamonds have market demand not just in the jewelry industry but also in fashion. According to a Business Standard report, about 4 to 5 large chemical vapor deposition or CVD diamond units have come up in Surat, and most cutting and polishing units are already working with CVD diamonds. So what do the opening of these new units of lab-grown diamonds tell us at a time when the core industry is facing a tough time?
Since this has come in new, there is some amount of disruption. The prices of mined diamonds had gone up, disproportionately, there's been an increase over the last few years to a great extent. And then you have lab-grown diamonds that are coming in, and they offer a significant cost benefit. So there are consumers, therefore, that are shifting, not just in India, but globally, that are shifting from one to the other. But over a period of time, things are going to settle down. Just now, what's happening in Surat is that the cutting and polishing trade can, it's the same cutters and polishers that can either cut and polish mined or grown. So I'm saying that it's the same set of people. Over a period of time, everything's going to settle down, right? You will have mined diamonds and you will have grown diamonds, and everything's going to peacefully coexist.
Experts hope demand for cut and polished diamonds may see a rise again around December-January. In the meantime, given the growing market for lab-grown diamonds, CVD units in Surat can employ diamond workers who have lost their jobs or are out of work, as the skill set required for CVD diamonds are the same. However, workers remain worried how long the recession will grip Surat's diamond industry that houses over 6,000 diamond polishing units and 8 lakh workers.
It is not just the Surat's diamond industry, but the financial markets too were recently shaken by global upheaval. The November has been good so far. The recent US Fed rate pause and the easing of US yields and crude prices have led to an upbeat start to the month. The benchmarks have recovered 2% from their recent 4-month lows. But is this rebound sustainable? Harshita Singh's report answers the question.
After a sustained downtrend in the last 1.5 months, equity markets saw a sharp rebound in 3 of the last 4 sessions. The BSE Sensex and NSE Nifty indices are now up 3% each from their lowest levels in 4 months, made recently on October 26. A dovish US Federal Reserve, which has raised hopes that the rate hike cycle has come to an end, has led the recent turnaround. But how sustainable is this optimism? Analysts say the recovery is only temporary, as coming elections and the war in Gaza will keep markets subdued in the short term. Investors are also not fully factoring in the higher for longer rate view, they say.
I believe it is a temporary recovery. I firmly believe that in the short term, at least for another 2 to 3 months, the market will be highly volatile with a downward bias. One, global cues. Global markets are also highly volatile. They are confused. The markets are confused between, economic recovery on the one hand and on the other hand, slowdown. Rate hike may be over, but then my worry is that the rate hike already executed above 5% in the US, and most major economies still have a very high rate. I don't think these rates are going to come down significantly in the short term. So the damage from what is already done on the interest rate part, that market has to discount negatively in the short term.
Besides, crude oil has erased all gains sparked by the Israel-Hamas conflict. It is now down 13% in the last 5 weeks to $84. But experts note that this is in part due to a China slowdown, which is another risk for the global order. Going forward, a significant rebound for the market hinges on a pause in FPI outflows. The US 10-year Treasury yields have begun cooling from their multi-year high of 5%. If this continues, FPIs will likely halt their 2-month selling spree, boosting domestic stocks, said Apurva Seth of Samco Securities. From a technical perspective, the recent bullishness is largely due to a short covering after markets were oversold.
Until 19,850 levels aren't taken off, this move or this bounce has to be considered as a short covering move in nature or a bounce back. You can say within a medium-term downtrend, only above the levels of 19,850 is where Nifty will negate low tops and low bottom formation. Else, until then, this can be just a bounce back or a sideways consolidation. On the downside, 19,000 is the immediate support, whereas on the upside, 19,500 to 19,700 are the likely targets.
Thus, it is too soon to cheer the recent gains on the Dalal Street, as the near-term outlook for equities remains downbeat. Today, on November 8, Q2 results of Lupin, Oil India, BHEL, MCX and Nazara Tech will be on the radar.
he's making plans for an early retirement. Business Standard.
After markets, let us shift our focus to the ongoing ODI World Cup. Sri Lankan batsman Angelo Mathews became the first cricketer to be given timed out in the history of international cricket. But how did Mathews get timed out? We explain.
The Bangladesh captain got rid of Sri Lankan batter Sadira Samara Wickrama when the scoreboard read 135 for 4 after 24.2 overs. The next man to take the crease was Angelo Mathews. And when he got to the crease, he realized that the strap of his helmet was broken and walked towards the dugout to change it. But Bangladeshi players appealed to the umpire, realizing that Mathews had not faced a delivery yet and the clock would cross the 2-minute mark before he could face one. The umpires then declared Mathews timed out. A new batter has to face the first delivery within 2 minutes after the previous batter is dismissed or retired. The Cricket World Cup 2023 playing conditions pertaining to timeout reads, after the fall of a wicket or the retirement of a batter, the incoming batter must, unless time has been called, be ready to receive the ball or for the other batter to be ready to receive the next ball within 2 minutes of the dismissal or retirement. If this requirement is not met, the incoming batter will be out, timed out. After the match, fourth umpire Adrian Holstock said that when it comes to timed out, the incoming batter has to be in position and ready to receive the ball within 2 minutes. And in this instance, the batter wasn't ready to receive the ball within those 2 minutes, even before the strap became an issue for him. So the 2 minutes had already elapsed before he had to receive the next delivery. Shakib Al Hasan was quick to make that appeal and send Mathews back to the pavilion. Shakib maintained that he was within his rights to appeal after being informed of the possibility as Angelo Mathews struggled with his helmet. Shakib said that one of the Bangladeshi fielders reached out to him indicating that the ICC rule says the batter is out if he hasn't taken guard within the 2 minutes time frame. So then he appealed to the umpires. The on-field umpires also asked Shakib if he is going to call Mathews back to the crease. Shakib said he won't call the batter back. Mathews, however, said that he was ready at the crease before the timer had run out. He had 2 minutes to get to the crease and get himself ready, which he did. And then it was an equipment malfunction. In a stern response, Mathews termed the particular action of Shakib and the Bangladesh team as disgraceful.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
South Africa's Andrew Jordan was the first batsman to be declared timed out in first-class cricket. Interestingly, he was declared timed out retrospectively about 15 years after the event in 1987. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.